Opendoor is an interesting stock to cover now because it's now become a meme stock. But earlier this year in February, I had this stock rated as a buy, and I had it rated as a buy all the way up until it became a meme stock. And when the stock price soared to around $5 per share, I quickly told my Discord community that it was an excellent time to take profits, that I didn't think that share price increase was sustainable. And then I made a video and told investors that it was a good time to take profits. And I downgraded the stock to a hold from a buy because I didn't think the valuation deserved to go up by all that much, right? Even though I was bullish on the stock earlier in the year and had it rated as a buy, that was when the market price was significantly lower. So if you were part of the community, you got to benefit from that. And if you weren't, then join, you can see the description for how to join. But in this video, I'm going to review the company's latest quarterly earnings results, and I will share with you my updated proprietary discounted cash flow valuation for this stock to share with you what I calculate to be a fair value for this business. Not considering the meme stock activity, right? I don't pay attention to those reasonings for buying or selling a stock because it's now a meme stock or whether it's not a meme stock. That's not my concern. I look at valuation. I'm a value-based investor. And so that's what I'll focus on here in this video, the company's fundamental performance in the latest quarter and what it can mean for investors and whether or not I think it's a buy at the current market price, which is now below $2 a share.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Opendoor saying that they delivered 1.6 billion in revenue in the second quarter and achieved their first ever or their first quarter of adjusted EBITDA since 2022, even as housing market conditions continue to deteriorate. And that's true. The housing market in the US has slowed down considerably through several factors. Uh, Higher interest rates have persisted, but higher interest rates have been around for a couple of years now. Higher prices have persisted, but higher prices have also been around for a couple of years now. But the main difference has been the slower macroeconomic activity. The tariffs implemented by President Donald Trump has slowed down economic activity in the United States, turning businesses and households more cautious. They're thinking more before they're making big decisions, and they're delaying many more big decisions until more information is available. One of the characteristics of the tariff policy has been not only that tariffs are higher, but they've been all over the place, right? They've been on pause, they've resumed, they've accelerated, they've decelerated. They're up one quarter, down another quarter, up 1 month, down another month. And when you're trying to make a long-term decision and you have such an important factor that's fluctuating, it makes it difficult to make a decision because you don't have the information. And so households and businesses have put on pause a lot of decisions because they just don't know. They don't have the information. They don't want to make a big decision now and then have the policy change 1 month later and then regret making that decision. So housing is one area that's already starting to feel the negative effects of that changing policy. So one of the other things that Opendoor is doing is focusing more on a lower capital business model, lower asset business model, where they're not completely going to rely on buying and selling homes. They're now going to work with traditional real estate agents to try and generate some high margin, low capital revenue here. They're building on that foundation by expanding their agent-led distribution platform, enabling partner agents to offer multiple solutions to each homeowner's needs. So some second quarter highlights include revenue of 1.6 billion, which was up 4% from the second quarter of 2024 and up 36% from the previous quarter. Gross profit of 128 million was flat from the same amount in the same quarter last year, and the gross profit margin was down to 8.2% from 8.5%. Inventory of 1.5 billion represented 4,530 38 homes, which is down 32% from the same quarter last year and down 35% from the previous quarter. Remember when I covered and I did several videos on Opendoor technologies for the previous quarter? I discussed the management team's strategy, which is reflecting the slowdown in the housing market. The management team saw this slowdown coming and they've undertaken a more prudent strategy. They've slowed down their purchases of homes. They've also slowed down marketing spending because they're not trying to attract new home sellers for homes to buy. They've also lowered the offers they're giving homeowners. They previously would provide offers of a certain amount to generate a certain amount of profit margin. They've now lowered those offers even further to have more of a margin of safety between the price that they're paying and the price that they think they're going to sell for, just in case the housing market continues to worsen. They have a larger margin of safety. And of course, I talked about this in the previous quarter that was going to lead to fewer homeowners taking their offers because they're giving homeowners lowball prices. Homeowners are going to say, you know what, no, thank you. We'll either sell with a traditional agent, a traditional listing, or we just won't sell and we'll wait till the housing market improves. So their purchases, as I forecasted, decreased significantly. They only purchased 1,700 homes, which was down 63% from the same quarter last year and down 51% from Q1. And of course, if they're purchasing fewer homes today, that means they're going to sell fewer homes next quarter and the quarter after that. So revenue and profits will decline because they're selling fewer homes. So adjusted EBITDA did improve to 23 million compared to negative 5 million in the same quarter last year. But unfortunately, management thinks that adjusted EBITDA is going to turn negative again. So this profitability was short-lived. In the third quarter, they're forecasting revenue of about 825 to 835 million at the midpoint. The actual range is 800 to 875 million, which would be an almost 50% decrease from the second quarter revenue of 1.6 billion. So a huge decline in revenue forecasted from Opendoor. They're also forecasting a big decrease in adjusted profitability, down from the 23 million in profit to negative 28 million in Q3, and that would be worse than the negative 21 million they reported in the same quarter last year. So I updated my proprietary discounted cash flow valuation for Opendoor Technologies following their earnings release. I now think this stock is worth around $2.70 a share. The current market price is $1.90 following today's 26% decline. And of course, I really hoped that you watched that video and you were able to take profits on this stock when it soared to around $5 a share. And I told everyone that it was a great time to take profits. And you can see my recommendation there downgraded to a hold on July 21st, 2025. But what do I think about the stock now following these quarterly earnings results and the big decline in share price? I actually think the stock is a buy now. I think that the lower price makes this stock a buy. I like that management is taking a more prudent approach to the slowing housing market. But I will say that this stock should only be considered for the very risk-seeking investor. If you're concerned about the risks of downside, or if you don't like to have your value of investments fluctuate, you shouldn't consider Opendoor stock. It's an extremely volatile stock, and even more so now that it's become a meme stock. So it's going to experience large fluctuations. The price could decrease by 50% in one day, even 75% in one day, but it can also increase by those same percentages in one day. This is going to be a volatile investment that's going to take you on a roller coaster ride emotionally and with your wealth. So if you're concerned about that, you should stay away from this stock. But if you like to take large amounts of risks for the potential for large rewards, this is that type of investment. It's a very high risk and high reward type of situation. So I have upgraded Opendoor stock to a buy following the company's recent quarterly financial results and the big decrease in the stock price. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.